Aziz is now joining us. He's head of emerging markets, economics research and commodities at JP Morgan. Jahangir, great to have you with us here. Good morning. Thanks very much for your time. Let's just tackle the CPI number which came out last night and the market reaction to it. Yields plunged, and this morning I woke up and yields were higher. The 10-year is up 8 basis points. What changed and what does this mean? I mean, is the market telling us something?
No, I think, the market is reacting to the fact that, you had headline inflation coming down as expected. It was a tad higher than what we had, in our forecast. I think it was the core inflation that was troubling the market. Again, in the core inflation, it did come down, but again, it was tad higher. But the core inflation is the big thing. And it essentially said that, it is getting stickier. And particularly, the favored indicator for the Fed, or at least for the chairman, which is core inflation less rentals, which is getting more and more sticky. So I think that's what the market is reacting to. And again, it's coming in the back of the non-farm payrolls again had a stunning number. The last print again, it was 14 months in a row. It has moved above consensus forecasts. So I think all in all, I think that's what the market is reacting to, was that, the things in the US may be bending in the sense that, things are slowing down, but clearly it's not breaking, at least not in the near term.
Okay, not breaking in the near term. Jahangir, good morning. So the expectation is that the Fed will pause and not move this week. Mm-hmm. But the other narrative is that the Fed could pause up until November this year and then take a call. Is that your view as well? And what are you expecting from this decision tonight?
So we've been talking about this, for some time in the last month. So that's our view. The view is that the Fed is going to take a pause over here, and that the pause is going to be prolonged. And in a sense, the Fed is going to let those long and variable lags to play out and see where the economy goes. The economy is in a slowdown trajectory, but the non-farm payroll numbers of the labor market isn't really cooperating. Inflation is coming down, but it's probably coming down tad slower, or probably significantly slower than what the Fed would have liked by now. At the same time, if you look at all the concerns that were raised about, the banking sector threats spreading out, that banking sector threat has been contained. If you look at the senior loan officers survey, those are still very, very elevated, saying that there is significant amount of banking sector credit squeeze. But at the same time, if you look at the Fed's own measure of financial stress, that has actually come down over the last month and a half. So I think all in all, again, it's the same message that, you have to wait and see where things turn out. And we don't really see a significant slowdown taking place till probably towards the end of this year and into the beginning of the year, where we do expect a modest recession. And perhaps in the first quarter of next year, that's when the Fed might comply with the demands of the market and provide them with the rate cut they'd be hoping for.
All right. Morning, Mr. Aziz from here in India. The markets, global markets are positioned for this pause. But what about the RBI? They as well went in for a pause. However, the commentary was read as hawkish. I wanted your comment on that, as well as, the recent data points where you have inflation coming down, IIP numbers looking up a little bit. So how are you reading it?
So I think more or less, the RBI was sort of looking at their own views about the Fed, and they sort of got it right that the Fed would go on a pause, and most likely it's going to be a hawkish pause. So I think tomorrow's the Fed, the big thing would be where the dots are pointing to. If the dots are pointing higher, then clearly the FOMC is signaling that most likely we might have to end up raising rates sometime down the road. I think the similar kind of message came out from the RBI 2 weeks earlier than the Fed. But I think, the Fed's decision was largely telegraphed because of what Jay Powell and the vice chair had said about 2 weeks back. So, I think the RBI was basically saying exactly the same thing, that look, inflation is coming down. Growth has shown a significant amount of resilience, surprising resilience somewhat, would say, and therefore, the next move could well be a hawkish move rather than a dovish move because the economy is continue to showing resilience, whereas inflation does not come down to the comfort zone. So I would say that was sort of a precursor to the kind of language that the Fed would be using tomorrow.
Jahangir, would a pause, right? I mean, Fed officials have kind of indicated to it, and that is one reason why the market expects a pause. But would it kind of throw markets into some kind of confusion? Because so far it's been steady, right? We're data dependent, and it's got to come off, and now suddenly you maybe pause because, well, you've hiked so many times in a row. With no, I mean, underlying, as you yourself pointed out, some of the data points, etc., are pretty still saying that the economy is strong, right? So does it? And by the way, three other central banks have paused and then restarted hikes again. Canada,
that's correct.
Australia, Norway. They all paused and they all started hiking again. So just wanted you to comment on that. Yes.
No, I think that's right. I think this idea that the Fed is just simply going to skip June and go back into July, which some commentators have been saying, I think that's a very hard thing to think about, right? In the sense that what exactly will you know in the next 1 month that is going to change your mind? And if you are so worried about things, you might as well do the insurance hikes, so to speak, right now. I think that the language of the Fed and the guidance of the Fed has been that last FOMC that they have reached the appropriate level, so to speak, and I think that they feel comfortable that at this level, if they basically hold this level for an extended period of time, the impact of that will gradually cool down the economy and bring down inflation. Recall that the Fed, while the Fed staff has a mild recession in the fourth quarter and the first quarter, which is also our call. When Jay Powell was asked this explicitly, he basically still believed that the U.S. could avoid a recession. So I think that sort of is where things are going. And again, in terms of the market, I think whereas there is a huge difference of opinion in the market, right, in terms of whether this is enough or whether or not they will have to rehike. We do have a risk scenario in our own heads that the Fed might be pushed into rehiking sometime in the future. But all of that is true. I think the market will accept that this baseline is what the Fed has had in mind. The baseline might not actually be exactly what the Fed had in mind. Maybe they would have liked a little bit lower inflation, but broadly it's panning out so far. Again, not across the board. Labor market inflation isn't doing exactly what they would want, but it's panning out broadly. So it's time for the Fed to basically say, okay, fine, let those variable and long lags of monetary policy tightening actually work itself out through the system.
One final question then, Jahangir, you have the data improving in our own markets as well, right? Whether it's the retail inflation or even the growth numbers. And that is showing up even in the stock markets in terms of earnings of companies, right, across the board. How are you feeling about growth now? Are you penciling in higher growth this time? And on the inflation front, what are your projections?
So we still think that inflation will take a very long time to slow down and core inflation will be sticky, and that the RBI will have a difficult time getting inflation into the comfort zone. On growth, we have a huge gap between what the RBI is thinking and what we are thinking. We are still thinking in the 5.5 range. RBI clearly has a significantly higher range. And again, our view is based on the idea that, look, emerging markets, whether it's China, whether it's India, whether it's Brazil, has shown a significant amount of resilience in the first quarter of this year. That resilience is dwindling, and the resilience will continue probably in the second quarter also. But beyond the first half of the calendar year, it is very difficult to see how growth gets supported simply because every other economy in the world, which are the big drivers of the global economy, and we're talking about the US and Europe in particular, is going to slow down and quite slow down quite sharply. In fact, I've used this language before on the show with you, that you need the economies to slow down, because without that, you're not going to be able to tame inflation, and you'll force these central banks to come back and start rehiking again. So I think there is not just, hope, but there's the need for these economies to slow down. But if the global economy slows down at that level, in order to bring down their own inflation down, then it's very hard to see emerging markets, whether it's India or China or any of Brazil or any of the emerging market, actually deliver the kind of growth rates that people, particularly in India, are penciling in at this point in time for the rest of the year.
All right. We'll leave it there, Jahangir. It's always a pleasure speaking with you. Thank you very much for your time. And I hope to have you back once we have the decision from the Fed and we hear from them as well. We'll take a very quick break here, commercial break. We are back. Our list of top stocks to watch with our research team lined up next. Stay tuned.